Good morning, everybody. Mike Vacchi, Princetontrader.com, here with your Monday morning pre-market webcast. Okay, we are sell rallies. We are in a band ride. We saw on Friday, we saw this pop up into the 51, 52, 52.75 area. Then over the course of the afternoon, the bears pushed that down on the back of the healthcare bill and were able to get back involved, first of all, with the lower band. Then they were able to push even deeper, go down and print 31.75. We opened up at 37.5, and almost immediately there was really no bid, no traction in the market at all. 27 to 29 has established itself overnight as potential resistance. We've traded as low as 17.75, and you're starting to see some higher lows up off of that. So if this last set of higher lows can push through 27.29, maybe they can retest the open, fill that gap, so to speak. But, if the bears are for real, and if the bears are really going to put together a solid week, then what you're going to see is the new weekly pivot is up at 51.67. If we do get a bear market rally, no matter how violent it is, no matter how good it feels, 51 to 52 has really got to be the limit of what price is capable of this week if the bears are really trying to change the character of this market. I don't expect to be in a lower band ride all week. I think the bands are going to continue to expand. They're going to expand past price, and we're going to end up back inside the bands. That doesn't mean that the bulls are necessarily starting to win. What will indicate that the bulls are starting to win is if we start to make higher daily lows versus lower lows. For example, lower low, okay? The bulls really had their chance right here if they were going to bounce it. The bears stepped in when they had to, then they followed through. And the spoils of that victory are what we saw in the Sunday overnight into Monday trade. If the bears rally again, they really can't exceed this 52.75 from Friday. And now they have the weekly pivot up there to support that. So keep an eye on that. When I say sell rallies, you've got to be careful, though, because if you start selling rallies really early, then you're going to be the squeeze. You are going to be the squeeze of these bear market rallies, which are violent and feel great, but ultimately don't go anywhere. It's better in the long run, if you can't be long, if you can't bring yourself to do it, to sit on your hands and wait. Sit on your hands and wait. Because, if you sat this out, if you sat all this green out, and then you waited, we print 52.75. Let's get over on the hourly chart. So you sat it all out here. This is Friday. You got a 52.75 hourly high. The high from the next hour is 51.25. You say to yourself, okay, we're building lower highs. I've got a high here I can wrap my head around. I'll go ahead and short it against that high. Well, you know what? That trade's going to pay really well. If you're instantly short every time the market starts to go up, and say you grabbed it here, well, I want to be short, and you shorted this rejection candle down at 45, and then it starts to do this on you, and you're down 2, then you're down 4, then you're down 5, then you're down 7. Most traders are not going to make it psychologically through that, and so you're going to get out. And what you're doing is you're getting out about the same time that you need to be getting in. I would rather you sit it out and just wait. If you can't bring yourself to buy it, and you've got to, and that doesn't mean it's going to work all the time. There's going to be lower highs that fail. But in doing that, you're taking very small hits and you're waiting for the one that works out. And because the downside moves are working out so well, you can get away with it. The nice part about a volatile tape is it pretty much washes away all the sins of entries. Your entries don't have to be as perfect as they need to be in a tight tape. But you can't just instantly short anything that you see. We've done 17.75 to 26. I missed the move down last night because I didn't want to short. I wasn't able to do it from here, from the 36s, and I didn't want to shorten the hole. And I missed out on this one from the 27.29, but I would rather miss out than get caught and blow a big hole in my account because I'm trying to short in the hole. So just a couple of tips on how to deal with this kind of market. And we'll keep going over this stuff, and we'll keep talking about it on Twitter and Instagram and everywhere else. So everybody have a good day. I will catch everybody for the midday update. Follow us over on Twitter, Instagram, and Snapchat at Princeton Trader. Check us out on Facebook and join us for a free trial at www.princetontrader.com. Trade 'em well.